Good morning. Welcome to YXI Insights. This is Yimin. Today is July 25th. We're pre-market open. We're going to cover the latest Tesla and Google earnings. We're going to do an FOMC projection from the futures market, and we're going to look at the equities seasonality for SPY before moving on to the charts for equities, bonds, oil, Bitcoin, Max 7s, gold, and semis ETF. All right, let's start. Tesla's Q2 earnings weren't very pretty. As you can see, the car sales dropped by 15% year on year to $15.8 billion. The regulatory credits declined by about half compared to a year ago, and the leasing segment also declined by 5%. But this was largely an expected result. The actual revenue actually came in above the consensus by Wall Street, and the EPS came in line. Looking at the energy generation and storage segment, we are seeing a decline of 7% from a year ago, but last year we had a pretty fast growth in this segment. The energy generation storage was doubling a year on year before, so coming off a very high base there. And finally, services and other increased by 17% year on year. Overall, what we really care about in terms of the current business fundamentals is the car sales and then the energy generation going forward. But if we're looking at 5 years out, the main revenue driver should be robotaxis. So if Tesla can put 4 million robotaxis on the road, each earning 25K to 30K, that's going to be a much more handsome revenue driver than the car deliveries. Elon is confident that by the end, a robotaxi network could reach half of the US population pending regulatory approval. On the FSD side, supervised FSD is pending approval from EU and China, which has been proven a little bit of a hurdle. And the new affordable model will be out in Q4. Looking at the metrics, the only thing that went up, or the only couple of categories that went up, were the Tesla locations as well as the supercharger stations. So in terms of production deliveries, Tesla saw a decline year on year, although they're higher sequentially compared to Q1. So now looking at Google, Google actually had a very strong set of results. So while we're in the golden age of AI, where people are using AI for queries, Google search actually brought in 12% higher revenue compared to a year ago. And actually, there is a lot of room, in my view, for Google to further monetize the integration between AI and search. So right now, Google has the AI overview within its search. When you type in a query, there's an AI overview answer. That has driven 10% more queries since its launch. And also, the AI overview product is being used by 2 billion people on a monthly basis. So this is a very strong set of results, given the cannibalization concerns for Google search versus AI. And I think when people query things like, give me the top 10 hotels in London to stay within AI, Google can always bring in sponsored names or paid ads into the AI queries just above or below the actual answers as well. So I think there is a lot of room for integration in that aspect. YouTube ads also up 13% year on year, very strong. And actually, YouTube Shorts now drive just as much ad spend as the long form videos. In the US, so that is very impressive. And I think the playbook is really what Meta wants to do, which is using AI to help advertisers create ad creatives, which would be a cost saving from third-party video makers or content creators. And then you can use that saved money to spend more on the market campaign and targeting of the potential consumers. So very strong, so very strong set of results here. And also the long form YouTube content. YouTube is ahead of Netflix as the #1 streaming platform. So Google Cloud up 32% year on year, very impressive. It's driven by increased cloud infrastructural demand, especially on the agentic AI side for enterprises. So Google is spending a lot more on CapEx this year and next year because they foresee a surge in demand they are desperately trying to meet in the coming years. So we should be able to see Google Cloud making more money, but also overall the Google as an ecosystem making more money from it. Google subscriptions, platforms and devices, that's up 20%, which is very strong. Google subscriptions include things like YouTube subscription, the premium subscription you pay to avoid seeing ads. So if you don't pay that, ad revenue will come to the YouTube ads, but if you pay for the subscription, the revenue will come to this bracket instead. Also, there has been a surge in subscription for Google One. And Google has a very strong advantage in integrating AI into its physical devices, as well as its Android ecosystem compared to Apple, who's relying on third-party providers for its AI. Finally, Trump visited the Federal Reserve building recently, yesterday, and there was a little bit a back and forth between Trump and Powell about the budget. Ultimately, Trump is not insisting on firing Powell, and I think he knows that if he does fire Powell, the market won't like it. What could happen is that if he fires Powell for cause, which is very difficult, no president in the US history has ever done that, a more dovish chairman could come in, cut rates, but that will drive the long end interest rate yield much higher, thinking about the 10-year, 20-year, 30-year, and that could increase the cost of servicing debt for the US government in the long term. Why? Because two things. First, lower interest rate in the front end could drive concerns for high inflation, especially when CPI and PCE are still not in line with the 2% target. And secondly, the loss of perceived independence from the Fed could fuel the aggressive fiscal spending and debt issuances from the White House, which can concern investors for the sustainability of the fiscal discipline, the supply risk of the low-end bonds, as well as the term premium, the extra yield that investors demand for holding long-duration bonds. So curve steepening may not be a good thing for Trump. So looking at the futures pricing for FOMCs, we're looking at between 3 and 4 cuts in the next 12 months. And that has been a bit tighter than last week, but it has been largely in this 3 versus 4 cut range for some time now. So no surprises there. Looking at equity seasonality, we're entering a now much weaker period in August in terms of equities performance versus July. And if you remember last year, we had the yen carry trade unwind from the end of July to the beginning of August. And as Wall Street empties and goes on holiday, market liquidity will be much thinner, the risk appetite will be much more reduced, and traders are likely to take profit and reduce the overall exposure before they go on leave. So we could expect high volatility and potential downside and pullbacks in equities in the coming weeks. Looking at our signals, been the same for the past week. Risk on for all of the assets, risk assets, except for TLT, and we're neutral there. We're preferring cash versus taking our position. Since it switched to zero, TLT did a little round trip, first going down, then rallying, and now back down to where we started. So we haven't really lost any performance there. While the risk assets have been consistently going up, except for Tesla. Returns for all of our signals since the V2 launch in mid-June, pretty good, especially for NVDA, 20% returns, followed by Bitcoin, 12%, Google, 10%, PLTR, 11%, Amazon, 9%. So pretty strong performance across the board, and with the exception of Tesla. But even if you look at Tesla, which has received a lot of negative sentiment, hate, because of its underperformance, is only down 8%, as mostly after yesterday's earnings as well. Looking at SPY, it's now pushing beyond the 1.76 extension of this wave one. So we're now into a stretch territory. I would be a bit more neutral here. I'm not going to be chasing new trades here and be waiting for a pullback. And pullback could land in this 590 to 600 level, where you have the 200-day moving average coming up for support, and the volume profile here. So here, this region here would be a natural supportive zone for the pullback. Very similarly, QQQ pushed beyond the 1.764 extension this week, this month, but is shy of the 200% extension of this wave one. So we are in the stretch territory, and again, I would be patient in initiating new trades. I don't mind holding if I already had a trade on and waiting for the model signals to turn, or perhaps ride out the volatility and having trading stop. But if I don't have a position on, I would wait for a dip, and that could come into the 510 to 530 region here, where you have the moving average and the volume profile in support. As the price comes down, this moving average will catch up to a bit of a higher level. TLT, my bias is towards the downside, both in terms of the fundamentals, as I talk about the yield steepening worries, as well as the technicals, where we're seeing lower highs and the lower lows. And I think the risk in the medium term is to move towards below 80%, and that would be 30-year yield in the mid-fives region. So I think overall, it has not been a strong few years for the bondholders, but the pain might not end in the short term. However, in terms of the absolute yield, 30-year paying 5%, it is pretty high compared to the earnings yield you would get from equities, as well as its historical performance. So if you're a long-term investor and you're looking to hedge some of the stock exposure, I don't think TLT for the long-term holding is a bad idea. It's just in the short term, I see further weakness potential. Bitcoin here, I do think we are seeing a clear wave for pullback. And this has been a repeated theme every time it does a run up. Bitcoin has a very shallow sideways drift to consolidate, big run up, drift, consolidate, another big run up. And we got a bigger pullback in May and June as the market digests this move. But ultimately that resolved into a new higher high at 122K. And now we're seeing a consolidation again. So that's very natural for me. Ultimately, I do think we will resolve higher into the 125K, even the 130K region for these end wave 5 of 5. Just looking at the G5 M2 money supply versus Bitcoin, it has been following pretty closely, not in terms of absolute levels, but the broader direction here. And over here, we are seeing a small correction in the money supply side that has seen the same weakness in Bitcoin too. So I'm not surprised, but ultimately, if Bitcoin is still following this lead, we should see new highs in the coming weeks. CLD, I'm pretty neutral here. Now it held this low in June. There is a potential for an immediate 5 wave up, which is a more bullish path. But as long as we're within this sideways channel, it's actually very difficult to tell which way it's going to go. So we're waiting for a breakout at this moment. And I do think this more bearish path that fills in the wave C or 4 before moving higher versus the immediately bullish path is a 50-50 right now. We did do a very fast run up between November and April, and the market just needs some time to digest. And if you didn't have a trade on, you would be wondering if it's worth aggressively moving in at these high levels. So I think it's quite natural to see period of consolidation here, but ultimately I do think gold should see higher highs. Apple is pretty well pinned between those two ranges. So we have a lower bound around 195 and an upper bound around 215. So it's been moving sideways for the past 3 months after the April rally. We are seeing signs of it attempting to break out here, but it hasn't yet. And I do think the 200-day moving average will be a major resistance because there's loads of volume profile around here who were back holding from this period here when they traded and could be offloading as Apple breaks even, and they're trying to rotate into other better performing assets. So I think we can't be sustainably bullish until it really breaks above the 200-day moving average and the channel resistance and over this volume zone. For Amazon, we pushed to the 200% extension of wave 1, so that is quite stretched wave 3 now. I think it's very reasonable to expect a dip in the coming weeks that could challenge the 210 region, so where we have the 200-day moving average again and also volume profile building around here. But ultimately, I do see a new all-time high and a higher high for wave 5. Google popped after the earnings upon good set of results, and reached the 100% extension of this wave A. So this is the wave C we've highlighted for wave 3. And it turned down immediately after reaching that. So it could still push higher to that 1.236 extension of this wave A to round off this wave 3 move. But the big move is now behind us. So I am more cautious now, and I would be a bit more patient in waiting for pullback. Our size also in the overbought territory. In terms of long term, I do think Google is still very compelling. The valuation is not too stretched. And I think for this, if we have a wave 1 up into the February 2025 and the wave 2 correction for the tariff crash, we could have wave C. We could have a wave 3 high in the 500s in the next 3 years. So long term, we're very optimistic, and I would be a willing buyer on major pullbacks for Google. Meta has had very shallow pullbacks, but in time of July, it's been consolidating sideways. So we haven't had a new local highs in July. And I think this is a wave 4 of 3. Preferably, I want to see a lower low in this wave 4, and that could challenge the 680 region. But in a bull market like this one, we might not get that. For now, I'm slightly neutral in terms of positioning going into the earnings. If we get a big pullback at earnings, I think that's a good buying opportunity for this wave 5. But otherwise, I would probably not chase it aggressively here in terms of the technicals. Microsoft, so a big pop after the last set of earnings, and then we have a new set of earnings just around the corner. And this, to me, looks like big money block trade buying in terms of building positions every single day. And you can see that the daily movement is within 1.5% almost every single day. And it's just been a steady curve upwards. And it is very possible that the target time deadline for finish building this block is the next set of earnings, which is next week. So we could see a big pullback finally in wave 4. When it trades over here, the valuation is actually not compelling anymore compared to, for example, Google or even Meta. So I'm very neutral after this big run up. NVDA been on a very bullish run as well. I do think now is the wave 3 is getting into the stretch territory near the 200% extension of this wave 1. If we get wave 4 pullback, we could challenge the 138 region where we have the 200-day moving average and volume profile here. But ultimately, there should be a higher high afterwards. So this could be a good buying opportunity. Tesla stock dropped 8% on the day after the earnings yesterday. But if you look at its performance, is actually being pretty resilient in the grand scheme of things. While a 14% drop when Elon broke up with Trump over social media, but he immediately recovered in the subsequent weeks. Then we had another 7% drop with the announcement of the American Party, and again, we recovered that. But we are seeing lower highs with higher lows here. So it's getting pinched into this bull flag, I would say. And we still have this channel support from the lower end. I do think this is wave 4, and we could resolve higher for wave 5 next as the major move. So even though the stock dropped 8%, it hasn't really fundamentally changed the outlook in terms of the technicals. We always know in terms of valuation, it's very punchy. We're relying on the delivery and the execution of the robotaxi network future, as well as energy storage and Optimus. So the execution into the next 5 years is crucial for the continuous success of this stock. But in the short term, I do think the technicals are still set up for further upside rather than downside. What could concern me is if this price level drops below the July 7th low and then also the June 5th low, because that is our wave 4. And if it drops below that, I think we have to really revise our outlook in terms of the technicals. But as long as those lows hold for now, I am still bullish. Finally, for SOXX, we're seeing early wave 4 correction. I think that could challenge the 210 area. This region is a 200-day moving average, but also this was the resistance trend line from 2024 into 2025. We broke above it. It's a natural retest before moving wave 5 higher. So that's it for today. Thank you very much. Any questions, ask me in the comments or in Slack. We'll see you next week.